Why did the US Bureau of Labor Statistics quietly erase 87% of the 1.4 million jobs that were supposedly showing how the US was a booming economy in 2025? And why did the paper price of silver crash 40% in a single day, and will it recover slowly or quickly? Will tech and AI stocks be able to rebound from oversold conditions, or will they fail and take down the whole market with them? Welcome back. I'm Nico de Boni, and in today's briefing, I'll walk you through my monthly report to give you the essentials that you need to know to understand what's going on and the key catalysts to pay attention for the next 3 months. Then I'll show you the graph that confirms that the rotation is over from tech and AI to the defensive sector. And I'll show you the key level I'm watching for commodities, the SP 500, Bitcoin, and the tech and financials, which are now kind of related because of all the investments in artificial intelligence. So let's get started. So here's my blog post. I'll just go over it very quickly. I'll put the link in the description below if you want to check it out. And so here's the first thing that you really need to know. It's the great rotation, basically, and it's complete. That's a key point, because here, if I just had to put one chart, I would put this one to show you how, since my warning at the end of October here, the Mag 7, so the top 7 stocks in the SP 500 and the NASDAQ, have been going sideways to down, but in the software, it's been really like a bloodbath. And so that's something you need to know. People have been rotating from these to the defensive sector. The problem now is that the defensive sectors are overbought, and the tech and AI, most of them are oversold. And so right now, if you don't have an actual rebound from tech and AI, the stock market won't be able to continue. It's been running on fumes, basically. And so right now, it really needs those to take the lead to restart a bull market. Otherwise, it's going to be a major reset with a decent pullback or a crash. I'll show you quickly. Here's an example of a sector that's clearly overbought. As you can see, it is like going vertical. It's the material sector ETF, which is XLB. And you can see how it's very recent, and since December, just took off because people realized that AI and tech was starting to be risky. And of course, people also went into consumer staples because regardless of what happens in the economy, it's a defensive sector. It's what people must buy regardless of the economic conditions. Here is a sector who's not doing very well. It's the financials, and it's because they are really linked with AI and tech because they are financing most of it. The XLY ETF is the consumer discretionary. And so usually when the economy is not doing well, which is kind of the case, it goes down because it includes all the stuff that people don't need to survive. So it's nice to have when the economy permits it. And you can see how recently it's just been going down quite quickly. It's still elevated, but it's kind of one of those sectors that it's not doing very well. Healthcare is kind of stagnating right now. And transport has been going up recently, which is kind of weird because when you look at the actual transport, it's not doing well. So it must be a sector where people think it's a defensive sector and they invest in it. Technology, clearly a sector that's not doing very well. It's still above that long-term average in green, but doesn't look very good. And utilities, it's one of the sectors that has been going parabolic because it's a typical sector that's defensive. So a rotation from tech into this was something that made sense, but look how vertical it's going. This is like more than 3 standard deviation above the average price. So a reversion to the mean is almost guaranteed for this ETF. In real estate, it's really surprising when you look at what's actually happening in both the residential and the commercial real estate space. It's really a bloodbath. Yet people put their money into this thinking, oh, it's going to be a defensive sector and it's going to be okay. So now the second thing that you absolutely need to know is that the labor market is finally showing its crack. So, I've been talking about this for a while, how the official statistic didn't make any sense. Well, now we know how much wrong they were. It's insane. Seriously, look at this. So this week, last week actually, the Bureau of Labor Statistics, the BLS, released the data for January and revisions for 2025 and for another period as well. And look what financial medias like CNBC run. Oh, payroll rose more than expected, and unemployment is down. But then they don't tell you that the BLS data was off by 87%. So basically their model was so wrong that it was nowhere near reality, yet they trust the latest print that is using exactly the same model. So Yeah, it shows you how you can trust the mainstream media headlines when it comes to stuff like that. And then even the BLS data, the way they presented it didn't make sense. You can click on both of these to get to the original source. So they present it as only a 403K revision when it's really a 1.2 million revision. Because here they say, oh, it's only going down from 584K to 181K. But I did the math, and here is the initial print they give us every month. So basically, if you trust the headlines and the print every month, they said that in 2025, the US added 1.4 million jobs, when the reality was 181. And many months were presented initially, like October, as a very positive month with plus 108. It ended up being minus 140. So they were wrong by 250,000 in just 1 month. So that shows you how bad it is. And so, yeah, basically, I use this analogy, like a good thing they don't fly planes, because if they think they are at 1,400 feet and they are only at 200 feet, they would be crashing right away in many buildings. So it's so bad that it would be better not to have any data than to have this kind of wrong data, because the Fed, investors, and government are making decisions based on this data. And so it's really sad. Another thing that you need to know is Kevin Warsh. So he's the nominated potential next Fed chair. And it was really weird because very quickly, he's been wrong in the past, like consistently for years in the face of evidence that no one can ignore. And people have been basically saying that he's allergic to data, which is bad. But I think the worst part is how stubborn he is, because even in the face of the 2008 financial crisis, he was still saying the economy is fine, we need to fight inflation, when there was actual deflation, price going down year over year, not going up or flat. So when you have a guy like this who wants basically to potentially hike the interest rate instead of cutting it and not print any money and basically the opposite of what Trump wants to do. So Trump's want to cut rates and they want a weak dollar to bring back job and manufacturing. And this guy we nominated is likely to do the opposite. So unless they have a deal that was not made public, or this is just someone is pushing it to be rejected, and then he has another guy that he wants to push next. Like, this doesn't make any sense. So anyway, if you want to click here, you'll be able to read all the sentence that he said at different points during the crisis, but this guy doesn't make any sense. Very briefly, for people who've been following me for a long time, you know how I think bonds have been great for the past 4 years until 2022. I think they will be the worst investment for the next 40 years because of inflation, debasement, and all that, which will completely reverse versus the last 4 years. But when there is a tactical trade, I don't mind taking it. And so I just wanted to mention quickly that I've taken a tactical trade on TLT because it's been shorted so much, people are betting so much against it, that I think there's a potential for a short squeeze, just like we had in silver in December and January, before the crash. So this is just to give you an idea of, sometimes I can invest in bonds, but it's very short term, and it's with tools like options to manage my risk and potentially benefit with asymmetric payout. And lastly, something I learned last week, which might be interesting, especially if you're invested in silver, is that silver doesn't have a normal distribution curve. So a Six Sigma event, although it's very unlikely, it's much more likely for silver than for other assets. It actually happens on average once every 19 months. So, for other assets, it's one in millions of years. So basically, that's something worth considering if you're potentially betting on silver having a major move, because, it seems to happen more than with other assets. And I put more information here, but yeah, basically, if you have a physical silver, I see it as a long-term insurance, so it's not about speculation. But regardless, if you have paper silver or physical silver, put option, which is like insurance, can work and help either way. So just something I thought I would mention because I had comments and questions. And here I put a long list of the main catalysts, and there are many of them in the next few months to watch for. One of them that I really want to emphasize is corporate buybacks. This is one of the two main elements that push the stock market up since 2009. The other one is the passive investing, basically people buying at any price each week or each month with their payroll and their employer. And so it removes price discovery because those people don't care. They just buy. And the businesses were doing the same thing by buying back their own shares. But right now, for the first time since 2009, big tech companies, which represent the biggest portion of the stock market, are starting to run into cash flow problem because of all the money they invested in AI. And right now, they are kind of starting to give some guidance that they will stop or reduce the corporate buybacks. And so if you remove one of the main buyers from the market, this could really trigger a vicious circle where everything reprices at once if tech brings down the whole market with them. So something definitely that I'll be watching closely. Yeah. And here I'll put the screenshot later when I'll do the analysis in the second part of this video. So if you want to check out the blog after to quickly check back the levels. And here you can join the free newsletter if you want to get timely alerts as well. So now let's go over the chart quickly and the key levels and how I see things. For the SP 500, I've given you a more in-depth scenario. For the other, I'll give you some key levels to watch and the overall assessment. So let's get started. Here's the SP 500 on a weekly basis. I'm just showing you the long-term trend here that has been starting in 2020 after the crash. As you can see, there was the first move, then a long bear market, second move, the big crash, and now we're back at the top of the channel. And so the most likely scenario is to go down. By how much we'll see. Here in green and red, you can see the zones of the risk reward I see. So right now I see about 4-5 times more risk than potential reward. And so I position my portfolio accordingly. And I think the most likely scenario is that we end up in this box here, which is between minus 26% and minus 42%. Worst case scenario, we would finish about here at minus 70% before restarting a final move up, which will likely coincide with a lot of money printing by government and central banks to try to restart a dead economy, basically. It's been mostly a zombie economy since 2022, hidden by all the AI investments that push the GDP up, but the real economy has been suffering. And so eventually, I don't think the government and the central bank will have another option than to restart all the stimulus they can do to try to jumpstart that economy, basically. So let's now go over Dow Jones very quickly. I wanted to show you how when it broke below that trend line here during the tariffs, tried to go back up, and every time it was rejected, that trend line. So we see it's an important trend line. But I'll go back on a daily basis for the candle. This is a topping tail. This is a very bearish sign. And so it means that the most likely is now to roll over. Something interesting also a few months ago, I told you about, it's very likely that the SP 500 will hit the 7,000 points and the Dow Jones 50,000 points because these are major milestones. And so it's kind of like a magnet. But as soon as you hit them, usually it's the top, when people are so bullish that they start putting out targets that don't make sense. And so look at that, it hit 50,000, it went higher, it was rejected, and then it's just been going down quickly since then. And SPX is basically the same. It quickly reached 7,000 here, and since then it went down very quickly, rebounded, went down very quickly, hasn't been able to really hold the lines. That's pretty bad. So now let's look at technology. As you can see with NASDAQ here, it's quite bad as well. It was rejected by this trend line. It was able to go up quickly, didn't make a new all-time high, so it's like a double top, which is also really bad. And then it broke down, tried to go up, broke down, tried to go up. So you can see how the momentum is really fading on the NASDAQ, and it has never been able to do a new all-time high since I gave you the warning here on October 29. It's even more visible on the MAGS ETF, which is for the top 7 companies in the SP 500 and the NASDAQ, so AI and tech companies. As you can see, the momentum is completely dead, so it's been flat to down, and right now it's kind of hitting levels that are really problematic. Here it's on a weekly basis, and here on the green you can see the super trend, which is kind of something you can use potentially as a stop level. And you can see there was a rebound right on it at the end of last week. So what will happen this week? Is it going to be the week that it breaks? It's not looking good, and you can see last time when it broke, it really went down. Something I'll be watching definitely. Another ETF that has been in the news recently was IGF. It's for software, and you can see how this one, it's not even pretending, it's going down fast. People have been, mostly retail investors, betting that it's going to rebound big, and as you can see, there was a small rebound. Let's go back on a daily basis. So here, everybody was betting it's going to rebound, and you can see how weak that rebound was, and then starting to head back. Market tend to overreact either way. So whether it's good news or bad news, they think it's going to be either the best thing and it changes everything and it's different this time, or it's the end of the world and you should sell everything and it's going to zero. So I don't think software is dead because of AI, but at the same time, I don't think it's going to rebound and it's going to be like nothing happened when the AI bubble burst. Remember, it's very different, the technology of AI and the financing of AI. And so the financing is what will kill the AI bubble, but it won't kill AI itself, just like the dot-com didn't kill the internet. It'll just take time for the company that survived to build back a strong AI architecture and business after the burst. But the burst is going to happen either way. So I think software will do better because some of them will be able to benefit from incorporating AI and not becoming like a Kodak, but some will just sink because they don't want to change and they don't want to adapt to the times. So it's just something that we need to keep in mind. People ask me about the ETF SMH, which is about semiconductors. And after the massive run that has been going on since the April lows when there was the tariff, so we're talking about 150%. A pullback or consolidation is expected. It seems to be running out of steam. You can see a double top here. It was unable to make a new high. The super trend has been turned off negative. I'm really not seeing any good risk reward right now to enter in this ETF, the semiconductor. So I think it's gonna go back down significantly with the rest of the sector eventually because it really went up too fast, and so just doesn't look good. Doesn't mean the companies are not great, it just means the price no longer makes sense, just like silver when I give the warning. So I wouldn't be investing here. In fact, I started shorting it as well because I really think it's going to go down at least in this area here, potentially much lower. Palantir is another company that I started to short around the same time that Michael Burry came out saying that Palantir may be a great company, but the financials don't make any sense. And so, as you can see, since then, it's just been going down. There was a rebound, but it's going down again. And I think it's really going at least into that area back between $100 and $60. And then it might restart, but regardless of the companies and the fundamental, the stock market price just didn't make sense. And now it's kind of starting to reflect it. And once the momentum turns, it really continues until there is either capitulation, which I don't see yet, or something major that completely changes the game, which I haven't seen either. Before we get into the commodities, I'll show you Bitcoin quickly. So let's go back here. Let's go back on weekly. So as you may remember, just before we entered that zone, the yellow box here, I said that I think we're getting closer to the bottom of Bitcoin. And so I said it wasn't the bottom, but I thought it was a good time to start investing with insurance, which is what I did. And the drop actually in the box and slightly below, but as you can see on a weekly basis, it wasn't really much lower, has been actually a gift because I was able to resell the insurance I bought at a major profit that paid back the insurance and my entry into the IBIT ETF, which is the ETF on Bitcoin. And so this is the kind of situation where when you know how to use options, you can invest anytime because you can do it in a smart way and you don't take the risks. Like for example, to simplify things, let's say I invested with $1,000 on the IBIT ETF and I bought $300 worth of insurance on it. Well, my insurance contract was worth, during the crash, $1,300. So when I sold it, that $1,300 paid back for the $1,000 of ETF and $300 of insurance. So basically right now I have free exposure, like free shares in my account of the IBIT ETF. And so if Bitcoin goes back up like I think it will, I benefit. And if it doesn't, I didn't lose any money. And so that's, I thought it was a good example to show you that you don't need to wait for the perfect time if you do it properly with the good strategy and the proper tools. And so now what everybody's waiting for, of course, gold and silver and other commodities. So let's go back on the daily because it's been kind of crazy, the movements. So if you remember, first, one clarification. When I talk about, when I buy and when I sell, I'm only talking about the speculative portion because gold, silver, and Bitcoin and other assets have their place in the portfolio, in my opinion, for long-term insurance. And so you may have a percentage in your portfolio that you don't touch. And so regardless of what happens, you keep this. When I talk about buying and selling for a tactical trade, this is like for the speculation portion to really increase the the return investment for the year. And so if you remember, or if you've been following me for a while, around here I say it was a good time to buy. Here I said I was selling. Here I say it was a good time to buy again. And here I say it was a good time to sell just before the big crash. And recently I started coming back, but it was clear this time that it wasn't, because I was thinking that we're at the bottom. I said it was a reset of asymmetry, meaning that where we are right now, I see that we are in a zone where it's likely gonna, move around this level. So it's likely gonna stay between 5,500 and 4,500 basically for the next few weeks or months, until the market has digested the big move here in both gold, silver. But this is just to say that right now it's not as crazy to buy, because there's less likely of a big down move. Of course, if there's a broad stock market crash, we could see gold, silver, and everything else sell as well, because people need commodity, they need cash, or they sell everything because they panic. But the fundamentals haven't changed, and so it's just right now I started getting back my speculative portion of the exposure, because I really think that by 2030, I think gold is going to be at least $20,000. And I think in July, there might be a big announcement in the US around gold. I don't know if it's going to be a gold-backed currency, gold-backed bond, or something around gold. But I think for the 250th birthday of the USA, Trump will announce something around gold. And so I wanted to be positioned with speculation ahead of it to be able to benefit if there is another big move. Now, and the key levels for gold, if it really crashes, I don't think it will go lower than about 3,500. So that would be my level to really accumulate, like for a lot for historical opportunity, basically. Now let's look at silver. So as you can see, silver, the lowest level I think is between 53 and 50. That would be again a zone that I think would really make sense, and is likely going to be the new floor price for silver. But between now and then, as you can see, it's about $75 right now an ounce. It could really go down a lot if it goes down to 50, 53. And the technical are not very good. The bounce was not very good. So remember when we were here and it crashed, and I said it's likely to go down here. And that's exactly what it did after trying to go back. It was rejected, and then tried to go into this zone, but it was rejected again. And so right now it seems to be kind of stuck in the lower portion. I think for the next few weeks, potentially months, it's likely going to stay in that range. I don't think it will make a new all-time high for at least a month or two, potentially more. But still, by the end of the year, I think it could be back to 150, and by 2030, it could be above $300. But it won't be a linear thing, so it'll be likely a long consolidation. It will get boring. Nobody will want to invest in it, and then all of a sudden there will be big moves again. So that's kind of how I see silver. Very quickly, I'll talk about the other commodities, although they kind of all have the same move. Like here is copper, and as you can see, around the same days you had the big move up and then the big move down. So one thing I'll show you the other ones as well. Like here's Palladium and Platinum. As you can see, they all have a similar looking chart. And one thing to note, and Uranium as well. People ask me about Uranium. You can see big move up, big move down. The one thing I wanted to mention is that if you look back at what happened in 2008 before the crash, we had a similar thing happening where everything was going up before. So the stock market, bond market, precious metal, they were all going up. Like it didn't make sense, but yet it was a warning sign that something major was likely to happen. And after that, when the stock market crashed, everything crashed as well, even gold and all the other ones. Then eventually gold recovered, but initially during the panic, everything was sold. And so to wrap up the chart portion, here we are back on the SP 500 chart with my forecast. That's my base case. I think there's 80% chance that this will happen. Of course, there's also the bullish case and the bearish case. The bullish case is it somehow continues, and I think that's about 5%. And the bearish case is about 15% of a crash, much worse than 70%. So that's still in the cards. You never know, if there's like a perfect storm of catalyst, which we have plenty of over the next few months, it's still possible. But right now, this is my base case. So the key for you is to really pay attention over the next few months to those catalysts that I mentioned on the blog, and also to not delay anything that you wanted to do anyway to prepare your portfolio to be more defensive, to reallocate stock based on your target weight and all that, because those moves, they're getting like more violent every time. Look at the 2020 move. Like, this was crazy fast. Look at the move last year without a worldwide event like 2020, and yet it went down extremely fast. And so right now, with the way the market is positioned, I mean, you could have a perfect storm where the stock market drop, 50% in 2-3 weeks. Like, this is in the cards. This is not out of the possibilities. And so you really need to be careful, especially if you're in retirement or close to retirement and you don't have 20-30 years to potentially get your money back. So that's the main message I wanted to leave you with. Of course, feel free to leave me any comments below. I'll try to answer your questions the best I can, and I hope this was helpful. So thank you, and until next time.